over the course of the next year to 18 months, we can anticipate at least a double. Then if it doubles beyond that, I think that would have to be a very attractive entry opportunity right now.
The closest thing to a polymath in investing is sitting across the screen from me. His name is Owen Tracy, and he's global strategist of Fuller Tracy Money. I've known Owen for many years now, and he's really my go-to guy for he's an all-terrain vehicle for all sorts of aspects of investing, whether it's macro, micro, long-term investing, trading. He can do it all. And he's here today with his very favorite stock, or his very favorite stock for US-based investors. I only learned the ticker literally moments ago. So we're going to unpack this company and find out why Owen thinks it's such a great buy today. So Owen, welcome.
It's a pleasure.
All right, Owen, like I said, you can talk about anything and sound smart, far smarter than I can. Right now, though, we want to know what your best pick for new money is. And you told me a minute ago it was Norwegian Cruise Lines. Can you give us a 1-minute elevator pitch, and then we can dive in?
Well, I think when you think about a new investment, it's about risk versus reward. So 3 things that I would look for are a trading environment where you don't have a lot of participation yet. Mm-hmm. Then you're looking for an environment where there might be a return of investor interest. So that gives you a signal that you might be in for a change. And then you need to find out, well, what would need to change in order for that thing to happen. So Norwegian Cruise Liners has been going sideways for about 3 years. And I think it's not that difficult to figure out why.
COVID, right?
We had COVID, and there was tons of people dying on cruises. And then they were being locked up and they couldn't get out of them. And it was negative. And it has taken a long time to get over that. So then you got to think about, well, what do they actually sell? These are floating hotels, and they're ridiculously expensive to build. So that also means that it's a very cyclical business. So when they make some money, then competition between the different cruise liners increases, and then they go off and they start building new ships and putting in lots of new things like wave riders or zip lines and all these sorts of expensive new accoutrements.
It's getting more extreme by the year, I'm going to guess.
Well, it is, but it doesn't happen by the year, because what happens is it's very cyclical. So what you'll get is a downturn in the market, which is what we've just had. Then they don't build new ships because they haven't got any money. And some of those businesses come very close to going bust because the ships are expensive to maintain. But then things start to pick up and they start making money. And I think that's where we are right now. So we are definitely seeing more interest of people in experiences. They don't want to buy stuff. They want to get the photos. They think that memories last longer than stuff anyway, and memories get better the longer away from the event that it has happened. So your memories get better over time, whereas your stuff gets worse. So that's really something that is helping to drive the experience trend in investing. And that's where cruises come in, because they have all of these little stops along the way and very well curated experiences where there are really beautifully photo-ready opportunities. And then, of course, who are the people in the market today who have money? Well, it's the people who are retiring. And the cruise liners, they really tend to market more towards the middle-class affluent or the older people. And those are the people who are taking cruises. But the important point is that that's where the growth is coming from. But we're in a point of the cycle right now where they're not going out and building a lot of new ships. So they're going to run the inventory that they have. So this is the income accumulation period of the trend. And those shares are cheap. So this is when they will start to report better earnings, when their PEs will actually start to come down, and then their share prices go up. Now, this is a trend that will last for as long as it takes for them to have the confidence to go borrow some money to build even bigger, newer ships. It's usually when they start building the new ships, that's usually when the stock price starts to go back down again, because they're now no longer profitable companies. They're starting to run losses because they're investing so much in their new ships. But we're a long way from that. And I think between then and now, there is a really good opportunity for a good size rally.
Interesting, interesting. By the way, I'm infatuated by what you said off the bat, which is there's not a lot of people in the room, so to speak, for trading, but there may be soon. I think most people miss that about investing. Like it's not enough to see the catalyst, like or see the reason it should be worth more. You need to see the reason that people are going to recognize that, and you connected those dots right off the bat. I'm guessing it takes 3 or 4 or 5 years to build some of these enormous boats. I have no idea, but it's not 6 months. So I understand the cycle aspect. One philosophical question I'd have, and maybe this is answerable, maybe it's not, is we could sit here and look and say, there's a time lag between when there's a lot of customers, and then they wake up and then they start to commission new ships, they borrow the money, and then when they're spending that money and maybe the customer usage flattens out, that's kind of the down cycle and the time to buy. Why wouldn't the market figure this out? If this thing has been going on and on, this is the same cycle, like wouldn't that cyclicality be priced in, or is just one of those things that happens because it's human nature?
Well, the market prices in events from day to day. But when a cycle is multiple years in the making, then it's very difficult to put a position on and wait for what you know is going to happen, because there's going to be something else in your portfolio is more urgent, is doing better, will demand your attention. Your people are calling you, telling you should buy that instead of this thing you're waiting for. So that deters a lot of people getting involved until there's an urgency factor. And it's the urgency that is the catalyst to get people involved all at the same time to drive a breakout. And I think that's where we are right now.
And this could be, reading through the lines of what you said, this could be a particularly good company for a retail investor. Whereas if I'm an institutional investor and I have an implicit 1 year kind of performance period that I'm being measured against, and maybe this is a stock that could be great in year 2, 2.5, or 3, that might be a little bit too long for me to wait if I'm an institutional investor. Like, even though I know the future, I'm a little restricted in my ability to act on it. But if I'm a retail investor, I can do whatever I want. If I need to wait 2, 3 years, no problem. Would you agree with that?
Well, that's all true. But then just think about that institutional investor. How does he build a position? Or how does she build a position? So what they're going to do, they're going to say, well, I like this thing, but it's not moving right now. And I have to think about how my performance is going to do over the next year or two. So when I take a position, because I don't want to forget it, I want to own it, but I can't have a large position. So what happens with institutional investors is that they build their position over time.
Mm-hmm.
The better it does, it justifies buying more. So as it starts to trend higher, then it becomes more viable for larger investors to have a bigger position because it is growing inside their portfolio and they can have a larger holding within it. So as a market is going sideways, positions are necessarily small because of the volatility, because there are other things in the portfolio that will be doing better. It's as the trend breaks out, it becomes self-feeding. That's how trends evolve, because not only is the story good, but the strength of the market justifies bigger positions.
It becomes more defensible, basically. Yeah.
Yeah.
Interesting. So what sort of gains, if I'm an investor looking at this stock now and saying, all right, I got a 3, 4, 5 year, whatever the holding period is, what kind of time period first are you anticipating the gains to come in, and what is the magnitude, roughly speaking, of the gains you might expect?
Well, I think that over the course of the next year to 18 months, we can anticipate at least a double.
Wow.
And then if it doubles beyond that, I think that would have to be a very attractive entry opportunity right now.
Wow. Wow. I noticed that I just looked very quickly in the 30 seconds before we started filming the one Wall Street analyst, or there's one or two estimates, they expected a flat stock over the next year. You're obviously saying that person, he or she is just plain wrong.
Well, I think that you have to also think about how do you survive if you are someone who's making
Yes.
predictions. Well, markets predict what they see. So an analyst predicts what they see. If they see a ranging market, they predict a ranging market because there's no risk to their job by saying a market that's going sideways will continue to go sideways. If you are an analyst and you are looking at a very strongly trending environment where the price is going up 3 or 4% a month, and you come out and say, I think the market is going to continue to go up 3 or 4% a month, you're not going to lose your job for that. If, on the other hand, you said, I think that market is going to decline 30% in the next month, well, if you're right, then you'll be a rock star. If you are wrong, you're going to lose your job. Nobody will listen to you. And if you say it wrong again the next month and it goes up 3%, and you say it wrong the next month and it goes up 3%, well, then people just will stop listening to you entirely. So the way that people survive, we tend to think of analysts and think about, well, they must really know what they're talking about. And a lot of them really do know what they're talking about. But how well are they surviving in their business? And 80% of the people that survive in the business predict what they see.
I'm so glad you said that, Owen. I have, I'll call it a mini collection of graphs showing that whether it's oil prices, interest rates, earnings per share, the long-term record of expert predictors is almost comical, and they do exactly what you say they do. They just look at the past and they just kind of mildly extrapolate over and over and over. If you look at the graph, it's hard to conclude that we have any use for these expert predictors because they literally just extrapolate what's been going on most recently. And once in a while, they're accidentally right, but I don't think it's because they know the business well. I agree with you on that, but I don't think there's a lot of value in predictions. Even though we're ironically here predicting a future stock price, you're approaching it from a bit of a different angle, and I think that's fair. And obviously, people have made money doing this. So anyway, I agree with you. Is the short version. What are some of the risks, Owen? I know these cruise ships are pretty bad for the environment. They use a lot of fuel for miles traveled, although the argument would be it's not really fair to compare them. They're not really transportation. You just float out there and have a party. And I've heard they're sort of like, I've never been on one. I heard they're like buffets, essentially, floating buffets. And one guy had a medical problem. I heard my dad went on one. And he's like, I was horrified. This guy was eating nonstop. And then he had to be, the medics had to attend to him somehow. Have you ever been on a cruise first? And what are the risks to this investment besides those semi-ridiculous ones I just mentioned?
Yes, I have been on a cruise, and took the family on a cruise, and it was a great little vacation. And we paid the bit extra, and we got the top of the line restaurant access. So we were not dining at the all you can eat buffets. But the all you can eat buffets definitely appeal to a certain demographic.
So you did not require medical attention on the cruise, I'm assuming, for at least for
I did not. No, I did.
Reasons. Yeah.
And you have to think that a lot of cruises, what they also sell is a drinks package, which means you can have an all-you-can-drink buffet. And a lot of people do that. Now, I also did not pay for that when I had small children with me. But what it really helps to emphasize is that these are party environments. So whatever you want to do, however you like to enjoy yourself, you can do it. And that is one of the major appeals. You don't have to drive home. You don't have to lift a finger. All your meals are fed to you. All your drinks are right there for you. There's lots of entertainment, and then there's all the stops. And they make money by selling up experiences on board. They make money by selling you excursions when you stop somewhere. Those are heavily marked up because you have nowhere else to go. They will sell you diamond rings on board. They'll sell you experiences. Then they will also have education on board. So these are closed environments, and they can try and sell you whatever it is you want, and a lot of people are very willing to pay for it. Now, what's the risk? Well, the risk is we have another pandemic, or that avian flu really does become a serious issue, and another flu-like environment like that. Well, people will abandon the cruise line sector in droves if we get something like that happening. Then, of course, what happens if there's a big economic downturn? Well, that will hit the more marginal buyer. It probably is not going to be an influence on the pensioners, but certainly for a certain demographic, they're not going to be able to take cruises. They won't be able to afford to go on vacations at all. That would hit the entire tourist market, not just cruise liners, but it's a potential outcome out there in the future. So it's not like this is a risk-free environment.
So yeah, they're super spreaders. So obviously, if we have a virus, they're not the companies to be in, and economic downturn makes sense as well. Is there any threat of new entrants, or are the capital requirements just too expensive? Wouldn't make sense. It's kind of an oligopoly, right?
Well, it's an oligopoly, but there are, I would say, half and half between listed companies and private companies.
Mm-hmm.
And of course, those private companies, we don't really know what they're doing, but there are lots of private cruise operators. But you can't just start a new cruise line. You need serious cash. It's massively capital intensive. So it's not like the supply of ships is going to double overnight. That's impossible.
I noticed on the PE ratio was a bit below the S&P 500. I think S&P is almost 30, high 20s. This was 23. Uh, that's undervalued by your measure, or do you consider PE much at all in your mental calculus?
I don't pay a great deal of attention to PE, but the reason that it's trading at a somewhat lower PE is simply because it is cyclical. And that is what is priced into the market, that
Mm-hmm.
it has been a disappointing environment for the last 3 years. That's why it's trading at a discount.
Got it. Well, I mean, it certainly has the makings of a good story. A company that's been around for a long time. It's a well-proven industry. You've got this tailwind of retiring baby boomers. You know, the demand is certainly there. Depressed price from COVID, but now could potentially bounce back, and then maybe once interest rates start coming down again, over the next year and a half, 2 years, then they'll start borrowing, but to build more ships. But in the meantime, you think this could be a double in 12 to 18 months, if I recall correctly. That certainly sounds very attractive. Have I summed it up right?
Yeah, I think you've summed it up pretty good.
Excellent, excellent. Well, I'm going to take a closer look at Norwegian Cruise Lines. It's just been out of my radar. I think because I've never been on a cruise, frankly. Like Peter Lynch said, buy what you know and love. And I've never done it. So maybe one day I will give it a try. My son was curious about going on a Disney cruise years ago, but now he's aged out of that bracket. And I think I could never get him to go on a Disney cruise, but maybe some other kind of a cruise. And like you, I will not get the all you can drink. I don't drink, so it wouldn't affect me either way. Oh, and if somebody is interested, they like this stock, obviously they can check it out on Yahoo or Google. But if they want more from you, where would you send them on the internet?
Well, just search for my name on Substack, or it's fullertracymoney.substack. You'll find me there, or just plug my name into Google. You'll definitely find your way to me.
And it's Treacy, Irish spelling, I'm guessing. We'll put a link up on the screen, or the address on the screen, and put a link in the show notes below. Owen, thanks as always. I've known you for many years. You've always been generous with your time and with your expertise and ideas, and you've certainly given us a good one here. I'm going to take a closer look. So thanks again to you, and thanks again to you guys, as always, for watching us at home.